Hello and welcome to The Chart Show. I'm Victoria Scholar, and this week's three charts are Zoom, Barclays and Moonpig. Shares in Zoom jumped after hours on Monday night thanks to first quarter earnings which topped estimates and thanks to a very positive outlook for the current quarter. In Q2, Zoom is forecasting revenue to hit $1.115 to $1.12 billion, representing growth of 9.2% versus expectations for 8.7% growth. And earnings are seen hitting between 90 and 92 cents, above forecasts for 87 cents. Now, Zoom, of course, was the poster child stock of the pandemic, faring extremely well through 2020 with 5 quarters in a row of triple-digit revenue growth. However, it's all been downhill in terms of the share price since October of 2020, with the stock suffering as investors shifted away from the so-called stay-at-home stocks, moving towards the reopening trade instead. And this year has seen an extension of those losses, with investors shunning the tech sector amid fears of rising inflation and interest rates. But Zoom's upbeat guidance suggests there could be reasons to be optimistic towards the stock once again, particularly given the structural changes in working from home habits that have endured post-pandemic and the decline in international business travel, with online meetings very much the new normal. Let's take a look now at the chart of Zoom, because we can see this strong downtrend that's been in play over the last year and a half, with lower lows and lower highs. And although we saw a bounce in the shares on results day, that doesn't necessarily mean the downtrend is over. Also, although shares are in a medium-term descending trend line, we are still significantly above the pre-pandemic lows, it must be pointed out, when shares were trading below $60. The major resistant hurdle to watch is at the psychological $100 mark. If shares can hold above that level, that could potentially pave the way for a new sideways or possibly even a more bullish phase for the stock. After 2 delays, Barclays has commenced its £1 billion share buyback programme this week. It kicked off on Tuesday and it said it will end no later than the end of September, as the British lender looks to return cash to shareholders and reduce the share capital of the company. That lifted shares to the top of the FTSE 100 on Tuesday morning. CEO Venkat was taken on 7 months ago to provide a clean slate for the embattled lender after former chief executive Jez Staley left amid revelations of his ties to the disgraced financier and sex offender Jeffrey Epstein. But it hasn't been smooth sailing for Venkat, who's been dealing with a blunder that saw the bank issue more structured notes than were allowed by the US regulators, leading to a hit of around £450 million to Barclays. Shares in the British lender moved higher on Tuesday on optimism that the bank is finally able to carry out its share buyback programme and move beyond the latest misstep. Let's take a look now at the chart of Barclays, because we can see there was this clear ascending trend line in play with high highs and high lows last year heading into the start of this year, as the stock recovered from the pandemic trough in 2020 and amid optimism towards the banking sector on expectations of the rising interest rate environment. However, this year has been more difficult, with the stock selling off sharply around the start of the Ukraine war to test lows around 140. Now it looks like the stock is attempting to regain ground once again, with 170 and 180 as the next resistance levels to watch. If it can push above, that could pave the way for the stock to head back up towards key psychological round number resistance at 200. Moonpig said it had agreed to buy Smartbox, the gifting experience platform behind Buy-A-Gift and Red Letter Days, for £124 million in cash this week. The company said there's a strong strategic rationale and compelling financial benefits from the tie-up, and the deal is expected to cross the line by the end of July. Shares in Moonpig jumped as much as 13% on Monday and extended gains on Tuesday as investors cheered the acquisition of this cash-generative, high-growth business. While Moonpig is best known for selling greetings cards online, its plans to expand further into gifts via this deal could help it broaden its product offering and boost margins, particularly for some of the more expensive add-on products beyond its bread and butter. Moonpig is also likely to benefit from significant synergies as the two businesses overlap and come together to save costs. Checking in on the chart of Moonpig, we can take a look at the stock price performance since its IPO in February of last year. We can see shares have really struggled, trading in a descending trend line with lower lows and lower highs, breaking below 200 at one stage this year. However, the stock has been attempting to regain ground off the lows, pushing back up towards 300 as the next key resistance hurdle. From peak to trough, the stock lost more than 60% of its value, as you can see. Perhaps now, given the positivity this month, we could be looking at a more bullish phase for the shares. Look for a break above 300 first, though, as a confirmation signal that the 15-month of bearishness is coming to an end. Meanwhile, look for support at around 200, and if we see a break below, that could potentially pave the way for further declines.